money. I'm sure if I ask all of you, do you guys carry wallets nowadays? Are wallets valid anymore? Then what do you carry? Your phone. Okay, so if you have a phone, can you do this to God? Yeah? I'm not going to ask you to take an oath to tell me that you've been doing all the right things with your money. I know you have not. Yeah? So today we are here, not because we don't know anything, but because there is power in knowing one more thing. Just adding a little skill about something you can do differently, and maybe it can change your life and the lives of those who live around you. So my name is Miriam. I happen to be the moderator of the professionals group here at the Consolata Shrine. And by the way, if you're not a parishioner here, I welcome you to come. First of all, it would be nice to have you as a parishioner, but you can also join us as a professional because you have something you can offer. Remember, those of us who are calling ourselves professionals, it's not like we are like the best experts you've ever seen in the world. But the thing is, like she said, Nekesa said about me, and about you as well, just that little thing that God has gifted you, you can gift others. So you don't have, your tank does not need to be overflowing for you to give. You can give even when your tank is not yet there. Okay? So what we do as professionals is, like this clinic, we hold a couple of clinics within the year. We try to do it every 2 or 3 months, we hold a clinic. And we bring all the professionals of different kinds. So this one is financial. We had a medical one just in the last, I think it's been a month or 6 weeks, thereabout. So we call the professionals, they volunteer. These people are volunteers. They don't get paid anything. So we just ask them to come and talk to our community, empower our community, let them ask questions that are bothering them, find solutions to real problems that they might be going through. So that's the same thing that we are doing here today. So if you have something that has bothered you in your financial space, you have the opportunity, imagine, and it's free, you're not paying for it. You have the opportunity to come and ask the people who will be sitting right at the front here. So we have a panel that's starting in a few minutes. I will be chased away from here by Nekesa in like a minute. So that's what we do as professionals. And the theme of this particular clinic is to be a good keeper of wealth. Remember, that is biblical. Yeah? So don't ever say nobody told you. It is biblical to watch over the wealth that God has given you. That wealth that you have is not yours. It belongs to God. And if you want to be a good keeper, then you have to do the right thing. You have to empower yourself. So without saying too many things, I want to welcome all of you. The professionals are wearing something like what I'm wearing with me here, the sash. So if you need help, if you need any assistance, if you need any question responded to, if there's feedback that you would like to give, please reach out to any one of them and let them know. Now, I think it's important that I let you know, although this is Nekesa's job, that this event is being live streamed. That is why you're seeing Richie here with all the gadgets, because there are people who are also watching us and they are not here. Okay, karibuni sana.
Thanks, Miriam. Maybe just to alert someone from the professionals group could check at the tents. We know that there's some number of people there who might miss the panel, so maybe direct them upstairs. If we can have that done, it would be great. So currently we are going to have the panel session. I know most of you are here to just learn and listen and get that extra thing that Miriam was talking about today from the panelists. So I'm going to welcome our moderator for this panel. His name is Sam Gichuku. Sam, most of you will, it's a familiar face, so you might know him as a journalist. But one thing you need to know about Sam is that he brings experiences, real life experiences and training to people. Like what he will encounter within the communities, he's able to showcase it. And not just through his journalism work, but also through the interactions within the community. And of value is that he's also very knowledgeable in matters economics, in matters business. So as he interacts with the panelists, I'm sure he'll ask all the right questions for all of us. And just know that at the end of this session, we'll have time for a Q&A session. So if you have any questions, please note them down. We're going to give time, ample time, to have the Q&A session. As it has been mentioned, we are live streaming. I think we'll share the YouTube link in the various groups if it has not already been shared. But it should be, probably by now it should be. We are live streaming. Please share with your relatives, share with your friends, family, wherever they are, so that they can at least get some useful information from this session. The gems, for those who don't know where they are, if you walk out and extreme right, sorry, I'm left-handed, you'll be able to see the washroom, so you can use them and feel free to just go there. We'll also have some health break after this session. So just be patient and we'll take care of the stomach as well. Thank you. Karibu sana.
Good morning. It's good to be here. For those that are asking, yes, this is my church. Richard knows that. And it's good to have all of you here to have a conversation this morning. Allow me to introduce the panel and then they can come. You can come to the front. Let me start by inviting Stella Mutai, who is an expert on mortgage and real estate matters. Stella. Linda Makatiani, family wealth strategist and finances, as well as generational wealth building. Winnie Kiragu is a financial advisor at Old Mutual. Thank you, Winnie, for coming. Then we have Martha Nzomo, who's an accredited financial advisor at ICA Lion. Brenda Mutola is a senior tax consultant at TaxWise Africa Consulting. Thank you for coming. Gilbert Wagabi is a financial advisor and insurance expert. Please join us on stage. And Peter Mwangi from Standard Investment Bank. Peter. Now, I don't know why we start the way we did, but we may want to blend so that so a lady here, a lady can come here, then you can sit there. All right, so let's first establish who is here. How many here are parents? Parents in the audience? How many here are yet to start a family? Okay. How many employees? Employees, not very many. How many people run businesses? Okay. How many are retired? How many are students? Okay, the rest of you, who are you? All right, it looks like our tool is not capturing everyone. Yes. Okay, retired but not tired. So I want us to start by talking about, because the theme today is to be a good keeper of wealth. And I'm looking at wealth as that seed that you plant. Those that have done a bit of agriculture, if you plant a maize seed, you have to wait a few days and of course have some moisture for it to germinate. Once it germinates, there are a few things that you'll have to do and watch it grow. There are things that you'll have to do. I hear there's something called top dressing fertilizer. You'll have to weed to protect it. And then it will flower, and then you'll have maize growing slowly. Eventually, you'll have a chance to harvest. You may harvest when it's green, or you may harvest when it's dry, so that you can convert it into unga, and you can bring it home for your family to enjoy a meal of ugali. So there's a point of planting, nurturing, value addition, of course value addition coming after harvesting, and I think that's what I want us to do, so that we are able to walk that journey to represent everyone who is here, all the way from those that are employed in business up until retired and not tired. Let's begin with you, Linda, and the concept of generational wealth building. What are you talking about here? I give you the mic.
Okay, thank you. So when we talk about generational wealth, we are looking at wealth that is beyond the current generation. So how do we build wealth? How do we get the younger generation to understand the value of this wealth? And not just the value, but how to be good stewards of this wealth, to grow this wealth beyond even their generation. So I'm thinking my generation, my children's generation, my grandchildren's generation, because what we normally see in society is we have parents who work so hard to build wealth, and they don't take time to impact that same financial literacy skills on their children. So that wealth is passed on to the children, but because they do not understand the value, then they're not able to grow that wealth. So it ends maybe with just the next generation. So for us at Finance for Families, it's very important. We encourage families, when you're doing your family financial planning, it's impacting financial literacy knowledge to the children as well. And when we say children, it's all children, not just the teenagers or the young adults who are starting to work. It's how do we get the 5-year-olds to start understanding the value of money? What actions can we be able to do? And most children learn from observation. So what is it that we are doing to make sure that they can be able to see? We understand the value of money, we are responsible, and from that they're able to pick the lessons. And I always say, there's that knowledge that no one can really take away from you. So whether your parents are there or they are not there, there's a way you can impact the family values, the financial values that your children can keep even when you're long gone. So that is how to grow generational wealth in our family.
Okay, we'll ask for a bit of practical explanations, but Martha, help us. At the family stage, where does that begin? Because you'll find that there are people who just came to Nairobi, or maybe it's their parents who were in Nairobi, their first income is a salary. How do you grow that in future to become generational?
Okay, thanks for your question. So I'll talk about it in very simple terms. So I like writing, drawing, so flow with me. Let's look at like the clock. So we'll go around 0 to 20 years, okay? 20 to 40, 40 to 60, 60 to 80. And this I'll break it small in terms of like life events. So generational wealth and life events. So 0 to 20, most of us are not making money at that point in time. So our work is, I think, to study, pass exams, and even maybe for those here, that's what you're thinking about. If it's in terms of money, maybe you'll ask money from your guardian, your parents, etc. You're not even thinking of how to make money then, really. So the major part starts from the 20 to 40, and that's where internship, making your money, your first job, etc. So that's more like now you're growing, that's when you start making your own money. Then move forward. So think of it like an individual, you're just starting your own life. 40 to 60, you get a +1. Now you start transitioning into a family, and your expenses, everything grows up. So it's not Martha as an individual, but Martha +1 and +2, 3, 4 because of kids. So your money or your wealth is spread into that number of people. Then we cross 40 to 60, 60 to 80. Now retirement is calling us, okay? So at all these phases, there are only 2 phases whereby you're creating money or generating wealth. So that's 20 to 60. But the other side, you're now spending, but from somebody's pocket, okay? So somebody's wealth. So in essence, you might not have your own wealth at that point in time. Yeah.
Okay, interesting. I just want to check if this is working, which is not. How can I make this microphone work? So that I can share the one I have. But in the meantime, Stella, so many people, especially the employed here, how many people here live in their own homes? How many people are renting? How many are living with their parents? Sister, I don't know how to classify you. Okay, right. Yeah. Yeah, so Stella, help us understand, because when that income comes from 20 to 40, one of the things you have is to finance your lifestyle, and part of that is your housing. How do you walk that journey, knowing too well there's so much pressure in this society? You want to live in the best of addresses, but then also you have to think about your income in a more sustainable manner.
Right. Thank you, Sam, for that profound question. One thing I can be able to say is that housing, or maybe a mortgage, maybe rent, is one of the highest expense that you'll ever pay in your income, or in your budget. One of the highest expenses is housing. And so even as you are graduating from the 20 years, you're coming from school, you are getting to work, or you're getting into business, you need to start thinking, do I need to get into renting, or do I need to get to own my own house? And for me, where I see it is, I always say it's good to be able to get into a rent or to a mortgage, whereby you're able to pay a mortgage to maybe like to HFC or to any financial institution. And once you pay this mortgage, at the end of it, all the house will be yours. Vis-a-vis where I'll be paying rent, and I know rent is an income stream to somebody. Vis-a-vis where you're going to be paying rent, and at the end of it, all this rent, it's like going to a bottomless pit. You do not know where it is, where it's going. And one day, one time, the landlord can easily tell you that you need to be able to move out of this house. So once you decide to be able to get into your first home, you can be able to graduate from the first home to the time that you, according to the stages that you are in life. So the first one, maybe I can start off by buying either a studio, or 1 bedroom, and once my income improves, I can be able to move even to a 2-bedroom, or even as my family is growing, I can be able to move to a 2-bedroom, to a 3-bedroom, and that's how you're able to build your wealth. Starting off from that studio, you can be able to pay off your mortgage early at HFC. We encourage customers, in case you get an extra income, you can be able to pay off your mortgage early, and this helps you to be able to graduate to the next property. So it helps you to build your wealth, and your first property becomes like a stepping stone to building your wealth. Like in due time, you'll be able to see yourself that either you're earning an income stream from the rental, or from the first property that you bought, and becomes an income stream in the form of rental income.
So how practical is that? Because as you're starting out, the salaries are not as high, yet you're looking at a percentage of your income, but also the cost of that mortgage itself, in terms of the amount of time and the amount of interest you have to account for.
Initially, it was more practical until 2017, when the government came up with the affordable housing agenda. And with the affordable housing agenda, we've seen supply coming into the market. When you see supply coming into the market, we've seen units coming into the market as low as $1 million. We've seen units coming into the market as low as $2 million. And someone can be able to start off with that $1 million. And you find that even this $1 million, $2 million, $3 million units, they are not out of time. Before 2017, or before the affordable housing agenda was there, the affordable housing units were outside town, far and billions. But now you see that they're coming in closer to CBD, are coming closer to where we have amenities. And so it is possible, and it is practical to be able to start off with that maybe a 2-bedroom, a 3-bedroom. I know the entry costs are usually very, very high. You find that you are supposed to pay incidental costs ranging in between 6 to 10% besides the deposit. However, you find that as financial institutions, you become very innovative, and you're supporting customers either to start off by saving, like at HFC, we have a savings account whereby we encourage customers save like in a new Bayango account, saving a Prosoma account, saving a Manaka account, and out of these accounts, they are earning interest. And it helps you to be able to save for the initial deposit as well as the incidental cost. Or we also have instances where you can be able to finance up to 100% or up to 25%. So you find that we are affordable for the energy costs, and we're able to reduce those energy costs. And in addition to the energy costs, with the affordable housing, you hear
university, we are able to access funding from KMRC, and now we are able to extend our financing to our customers at a single digit rate or at a rate below 10%. So you find that well, by the present, the current operating environment, where we find that interest rate that ranging in between 16 to 20%, at affordable housing, we're able to affordable housing proposition, we're able to finance our customers at a rate of in between actually an HFC at 10.5%, which means that you are able to match your rent that you could be paying, you are rent to that mortgage. And at the end of it all, when you pay a mortgage as an ISA, it becomes your house.
Okay, interesting. We'll get back to you for more. Peter, so it sounds like Stella is telling us that if you start early and buy a studio house, then you keep graduating, it becomes an investment because you can collect revenue out of it. What are the other options available, especially for those that are starting out in life, that they can pursue as investment opportunities despite low incomes?
Okay, that's a good question. Basically, I might say that of you, we know money is transient in nature. Even when there is so much around, it takes a special financial character to understand the power of money. You have to work to grow it, to protect it, and preserve it. How then do you do it? You have to have a budget, of course, and you have to stick with that budget. You have to chase where money comes. Remember, you are not going for big wins. Appreciate the small wins that you make. And again, also track where the money is going, the expenses. Live within your means. If you are starting up, we have some various opportunities like money markets. And remember, money markets is able to enroll even those who are uninvested. And you can build your wealth. And that flexibility again brings the element of you have also have a buffer, have a settlement, have your emergency funds that can take you 3 to 6 months. So when you're having an market fund, for example, most of them will say the minimum investable is 1 million, 1,000 shillings. Some will say 5,000, which is within the needs of those who are starting. So as you build your funds, you can now transition to a higher alternative. Like now, for example, in Standard Investment Bank, we have a global fund in Goldman Sachs that is able to shape the market in terms of returns. But then the starting point is actually high. You start with the minimum of 50,000. But that person started, for example, with a market, let's talk of CS, for example. I'm able to raise like 2,000 as minimum investable. And the minimum top that I can afford to do is 1,000, which is within the range. Then I'm able to build my money with the rate of around 30%. And after I have accumulated enough, I can transition to a higher fund that will give me global exposure. Remember, when you are preserving your wealth, you also have to look at the issue of diversification. You don't put all your eggs in one basket, at least to spread risk. The other thing I can talk about now, as you transition to the next level, you also have to ensure that you protect the investment well. Because let's succeed in the journey of wealth creation, there's no sprint. It's not a sprint. It's a marathon, and it requires discipline and be able to stick to the course. And by that, I think for the starters, they have a win. You start with money market funds. We have like 29 active fund managers. The minimum investment to start is you can start what connects also. You can start with 1,000 and do a top up of 100. That is within the needs of most of us who are starting. So you can really become from one market, go to another, and then diversify to other options as you protect your money, take a cover, do family planning, now start investing directly in real estate. You don't necessarily have to go and think of buying a property that is worth 20 million. Maybe if you did this beyond your means, but you can participate in real estate by going to what we call real estate investment funds, and they give you a chance to participate in real estate as well.
Okay, you've said many things, but before we carry away from you, you've spoken about money markets that are giving rates higher than treasury bills and bonds, even higher than banks anyway. how do you assess what is secure for you? Because you also don't want to suffer fraud.
Thank you, Sam. I happen to be in that market as a subject matter expert. What I can tell you, money market fund, they are very good at community. And of course, there is what we call the intensive strategy, whereby you have a fund manager, you have a custodian among the commercial banks, especially the first tier banks, you have a trustee, and of course the overall oversight of the CMA. So that intensive strategy itself, ask yourself, we have some companies I'm not mentioning because it's not a mandate to mention, but they have some products that have failed the market. People lost money, but what is in the money market still operational? Ask yourself, what happened? What they have maybe like a private placement, people lost money. Because it was not that the regulatory framework of CMA, but what was in money markets? It is still functional and even making the top 10 list. So basically, as you scroll through the money market funds, you have the comfort of going maybe to the stable fund, look at their corporate governance, look at the returns they are giving, look at the portfolio performance historically, and then maybe the assets and the management, because it's also key. But overall, CMA has key primary objective, investor protection, and also market efficiency. So they will never allow any market fund to go to the dogs, of course. Because what it means is that if that market fund falls, it is the entire capital market that cripples. And that's why you can see they are only a certain solution to a certain company, still functional, but what they were doing private, people of money. It's because CMA was doing the oversight and cannot allow that to happen.
Okay, all right. Winnie, so speaking about insurance, and I think Peter has referred to it, that you also have to buy different covers. Help us understand how that speaks to wealth creation.
Okay, thank you very much, sir. Basically, for the insurance act as a protection, you've seen people doing the flood, their houses being taken away, and that doesn't go back to them to zero. Then you've seen a lot of maybe even you have a for contribution for critical diseases like cancer. With a critical disease like cancer, whereby someone want to go to India, if you look at your contract today, you can check and say you cannot get 3 million within a day, isn't it? So instead of that, there is a cover that called a critical illness disease. With 1,000, you are able to purchase that, and maybe to reduce the burden to the family and to the other person that you are allowed to do. Basically, for insurance, work as a protection. You see someone has a lot of assets, and maybe within a day, that asset can be one of the persons who are breadwinner in that family, and you get a very bad like abuse in the hospital. That will can go within a day. Basically, for the insurance, you have to do so that you have a cover to protect what you have. If you're employed, I know you have something called group life, but as an individual, if you do that job, you are opportunity can still go to the street. So what you need to do, ensure that you have a liquid health cover. The liquid insurance is like a life cover whereby it stays attached to your family to ensure that your children will not go back to the street. And the other thing we talk about is about when you are walking. Even today you can get disabled when you are walking, you cannot buy Buddha. And you have a goal maybe you want to achieve a house. That goal, you cannot reach that goal if you are in the system, you will not protect yourself. So the insurance is about protecting what you have and then protecting your own. Because we can talk about what here, you can accumulate a lot, but within a day, it can be clear. So you need to protect what you have.
That's interesting. So how do you make this conversation palatable, especially to the younger people? Because if you tell them that something bad may happen to you, sometimes it's a distant conversation. How do you make it to form part of the life conversations, lifestyle that we have?
Basically what we do, we help you to understand where you are. One thing we look at is what are you doing? What are you doing on a daily basis? If you're working in a risky area, today God forbid you are on a boat and then you're trying to live your life. God forbid you get an accident and God forbid you are no longer there. Within that, we can take a couple of ensure that your family will not be auctioned because you had a mortgage. Your family will not be auctioned because you had a loan in the bank. To ensure that each and every the life insurance or even the health insurance is very affordable to each and every person. With 1,250, you have a cover of 250,000, even if you are a student, which can protect you, ensure that you can work the architect. Because even if you save for many years, I'm very sure you have seen people having a lot of flats. They have a lot of assets. Sometimes it can be a physical asset. If you have not protected it, you will always be sitting here approach somewhere. But if you can know how to protect whatever you have, that is a house. And then our mind about protecting, we talk about distribution. Because when you talk about insurance, you have to also distribute your wealth. You can have a cover and you never indicate any beneficiary in that cover, or nominated anyone. The cover, we cannot know who to pay in case of such a situation happen. If you have a trustee, very good. If you have a trusted family, very good. Because you have seen that even when you invest, we are doing a financial matter. We talk about somebody investing very Dubai and a lot there. God forbid that person died very long time ago. And then there is a neighbor who keep on checking on that road. They have never seen you for the 10 years. That child will remain. It will be clear because you never nominated one of your family member or your beneficiary or your lawyer.
Okay, that's a very good point. And I'm sure we'll get back to it when people are talking about communicating about the covers that you have and the risks that are involved, especially in the Kenya that we live in today. But Gilbert, so then, when you're looking at, especially starting small, going up, knowing too well the uncertainties of life, the uncertainties of sometimes the economy, there has been job losses if you have to track from the year of the pandemic, 2020, 2021. What is that financial planning that people can get into facing reality or knowing that once you start a family, there are costs that will come, whether it's about school fees, or it's about house rent, or just taking care of your family?
All right. Thank you, sir. Let me put it this way first. God gave us something called hope. Right? You woke up in the morning, say you're coming to church. You don't know if you'll make it. Alright? You don't know if you'll have an accident, you don't know if there's traffic or something. So ideally, when you're planning for your life, I tend to tell people, just think about the positive first. Think about the positive. Wherever you are in life, whether you're from what Martha was saying, whether in dependent stage, whether you are in accumulation stage, which is now maybe 20 to 40, whether you are in consolidation stage, which is 40 to 60, whether you're in retirement and you're not tired, it all depends. Where are you in life right now? What do you want to achieve? Think about the positive aspect of it, then you start. Best time to plant a tree, 20 years ago. But the next best time is now. So, an hour and a half, just start slowly every single day, every single month, and it will grow. But think about the positive. But also, in case, because I'm in the insurance world, anything can happen. Insurance is the business of transferring risk. So in case that something is to happen, and you're thinking about where do I invest, where do I put in, the pandemic, no one saw it coming, it was there, so that's a possibility that from then until now people are thinking it might happen again. So what you do is do a lot of research. Do a lot of research. Sit down, look at this bank, is it giving HFC, is it giving better rates, how long have they been there, what returns are they giving, what did they do after when they went down, how did they come back up, all that. When you do a lot of research on anything, including even getting a wife or a husband, you have to do research and know this person comes from a good family, this person comes from peace, whatever. Depends on how you look at it. But so if you're planning for your future, same thing as if someone's coming to your house in December for Christmas, for two weeks. You'll clean the house. You will make sure the bed is proper. You'll buy mattresses, you'll buy everything. That's planning. So if you can plan for a visitor, why can't you plan for your future, your retirement, your children, education? I want to live in a space whereby if, in case, God forbid, I pass on, or when I do pass on, people cry because I have passed on, not because there's a well or there's a tap that has now been closed. Right. You get it?
Okay, interesting. And I'll be taking questions from the audience shortly, but first, Brenda, in all these conversations, one of the greatest costs to our incomes is tax. How many people here are concerned about the tax they pay? How many people here are happy with the tax they pay? Sorry, Kenyans. So, Brenda, help us understand what options exist so that even as you try to maximize on the much that you can earn, how can you get tax advantages along the way in your investment plan?
Nowadays, when you just speak about tax, it's just controversial. Everyone is just like, another tax is coming up. But there are ways you can save on what you give. Like right now we are in church, it says give to Caesar what is to Caesar and to God what is to God. But our principle is you should not pay even a cent more than you should. So the most important thing, first of all, given the current changes in taxes, it's very important for you to be at least updated. You know, most people when they hear tax, they're scared. They throw the responsibility to someone else. So I think it's very important, first of all, to understand what is going on in the tax development systems right now. So in terms of tax planning, what we are discussing today, tax planning is how you can manage your affairs. We are talking about generating wealth, we are talking about financial plans, but now how do you plan your affairs so that you minimize the tax liabilities you pay and you maximize your revenue? Paying taxes is necessary so that we can develop the economy, but you should not pay more than you should pay. So it's very important to understand how you can save on what you pay. So I understand we have employed people here and we have businesses. So I'll start with the employed people. How can you save on what you're paying as tax liability? So we have two options, actually three. So the first one, we have what we call deductions. When we talk about deduction, we are talking about amounts or certain amounts that you can deduct from your salary that will be taxed. So say you're earning 200,000. Now, if you don't have those deductions, the 200,000 will be subjected to tax. But if you have some specific deductions, you will reduce that amount that will be taxable. So what are these deductions? We have, for example, we have been speaking about mortgage. If you take a mortgage for your owner-occupied property, you can deduct up to a maximum of 25,000. So if you're earning 200,000 and you have mortgage for your owner-occupied property, you can take like the 200 subtract 25, so the amount that will be subjected to tax will be the difference. But now at the same time, you don't go to take mortgage because there is a tax advantage. You have to analyze cost-benefit analysis. Say for example, you want to buy a house using the mortgage. Have you looked at the current scenario? Is that house you're going to buy overvalued such that if you are just to buy a house normally or construct it's cheaper? So even when you're looking at the tax incentives available, you need to do a cost-benefit analysis. Another deduction that you can have is retirement planning. I've had them speaking about it here. Registered retirement schemes. So there is a deduction that you can get up to a maximum of 20,000. So we have, for example, the NSSF, that one, and then we have these other registered schemes. So the most important thing is that you save with a registered scheme. Another advantage for retirement planning is once you get your first payment, lump sum, 600,000 is tax exempt, and then for people who are above 65 years, the monthly payments that you get is exempt. So that is on the deduction side. on the relief, we also have relief. I mentioned this is for salary people. We have relief and we have deduction. I've spoken about deduction, which reduces the amount that is subject to tax. And then now I'm talking about relief. We have personal relief. You all know as an individual resident in Kenya, you are entitled to a personal relief. Per month is 6,400, per year is 28,800. So when you're filing return, you're supposed to make sure that you claim that relief in your return. It will reduce the tax payable. Then we also have insurance relief, which is 15% of the premium paid. It's capped at 60,000 per year. So we have, it used to apply, most of us had it on NHIF, but now we have SHIP. So we had a confusion when some employers claimed that relief, and then KRA came later to say that it is not applicable to it. So that one is still a gray area, going with the developments that are happening right now. We also have medical fund also has a relief, and also we have affordable housing levy. There is a relief which is capped at 9,000 per month. So those are some of the things you can look at as a salaried person. I can go to business?
Yes.
Okay. Before I move to business, there are some other advantages. If you are a person with disability, you can apply to the commissioner so that you can have tax-free 150,000 per month income. So if you know anybody with disability, they can apply to the commissioners. You just get the exemption. Any income you get from 50,000 and below is tax-free. You just get your money, but you need to apply and get the exemption. Yeah. So I'll move on to the business side. I've been speaking about the salary people. I hope I've helped someone here. Now to the business side. Now we're talking about corporates and small businesses and the likes. So back to the salary people, if you have any other source of income, it's advisable you set up a company. Separate your finances, business, and corporate, so that you can be able to claim these expenses and reduce the tax payable. Also, if KRA come for you and you have not separated your businesses, they will get you personally to your accounts and everything. So it's very advisable. If you have any other sources of income, set up a company, let it be distinct so that you don't become liable for the company's liabilities. Now for business, there are options available. For example, number one, when you have your revenue or income, you can deduct expenses that you use. Remember the deductions that we spoke about. Even for businesses, you have businesses expenses that you can deduct from that amount subject to tax. But now we also have new demands or new expectations with the eatings. Now initially you could just, if you are a business, you have incurred these expenses, you could claim, like your revenue is 500,000 and you have business expenses of 200,000. So the difference is what you tax. But at the current, given the Finance Act, it started in 1st January 2024 this year. You have to support all those expenses that it is invoiced. So that this is where most people will get quotas. So every expense you claim to reduce your revenue, you have to support it. Although there are exemptions like salaries, which is emolument, we have imports, investment allowance and other things. But those ones, it's a fast stretch for you. So for you, basically make sure that all the expenses, at least you support them, because audit will come up and now they will go to companies. That will be their aim. Something else you can look at is the financing options that you have. How to finance your business, if it is loan or equity. Most people go for loan, which is better because they can be able to use that interest as a reduction to reduce the amount taxable. But you know also the government has come to that, such that if you want a loan, there is a cap of how much you can deduct. So basically what it is saying is that you cannot just take a loan and use that interest to reduce your revenue unless you're also bringing in revenue. So they have capped the amount of loans you can use to deduct to reduce your expenses. So you also need to be careful when you decide to finance and you're going for the loan because you can get the interest. There are so many restrictions about that, but if you're sure that loan at least is going to generate income, then you can go for it. Other items, just to summarize, for example, is the investment allowances. If you have, for example, a motor vehicle for your business, you have a building, of course the cost you use to buy it, you cannot use it to deduct, to reduce your income. However, we have an option for investment allowance, which, for example, motor vehicle, 25%, you can be deducting it from your tax payable. Then other plans that you can use, for example, for the small businesses, you can be having a small business which is family owned, and then you have the owners are getting the revenue through dividends, right? So how do you get to dividends? To get to dividends, you have to compute tax due subject to 30%, then the remainder 5% to give dividends. You do not have to do that. There's a way around it. You can have the owners getting salaries as directors' salaries. You get. So when they get directors' salaries there, they have the taxes taxed at a graduated scale, not at 30%. There's relief and all that. So that is just a way around that, so that you can at least save on something. There's a lot to say, but
that's interesting because what if you are employed and you run a business and your director's salary is, say, 50,000 shillings, the employment income is about 200,000 shillings. So will you pay the graduated scale, or you're going to pay 35, what is the other term, 32.5 or 35%? What will you pay?
No, that's the issue of secondary employees. That's another current issue that people are raising with care. You know, relief and all this, you're only entitled to your primary employer. So if you have your primary employer, like the main employer, that is why you enjoy all these deductions. Now, the questions that are being raised is that initially, if you are a secondary employee, your tax was the highest tax band, which was 30%. But right now, this is now a current problem, and there's still no resolution. Any other, you're being taxed at 35% or 32.5%. So I think the first solution I gave applies if that is your only source of employment.
Okay.
Yeah.
All right. Do you have someone who wants to say something? Because I want to take questions from the audience. Who has a question from the audience? Wow, no questions. I guess we're doing the right thing, or maybe the wrong thing. We want to hear from you. What are your concerns in your businesses, in running your family finances? Miriam? You can get a mic for Miriam, and then also the panel, you can be thinking about things you want to add.
Thank you, Sam, and well done to our panelists. I want to direct this question to HF. Stella, why are you cringing? So there's something you said about the arrangement with the Kenya Mortgage Refinancing Company. And I think a lot of us here would be interested to know, let's say for argument's sake, our salaries in this country, as we all know, most of us earn below 50. And there's quite a huge majority that is even in the category of, say, the minimum wage, 17, all the way to about 30,000. That's where majority of us are playing. That's a fact. Now, if I'm paying rent, I'm in that category and I'm paying rent of, say, 8,000 shillings or about 10, how can KMRC come in for me? How do you see that playing out practically?
All right. Thank you, Miriam, for that question. Can I respond some or?
Yeah, go ahead.
All right. Thank you, Miriam, for that question. And I will respond it in twofold. And the developments that are happening in the market. With affordable housing, it has been able to graduate from 2017 to where we are, where it was the agenda for the previous regime and the current regime. We still have it as a strategic pillar. And the changes that have happened over time is that when the houses are being constructed by the government, they have three categories. They have the social housing, they have affordable housing, and they have the market rates.
So in these three categories, what the government is doing, and this, I think, they communicated to the financial institutions as late as last week, is that for the people who will be buying their houses in the social category, and this is where we have houses ranging in between $1 million to $3 million, and this is right now we'll be able to have the people at the lower cadre qualifying. You find that the government wants to be able to advance money through KMRC, and this is maybe within the year or maybe probably come 2025. People will be able to enjoy rates at 3%. So with 3%, somebody at earning income below 50,000 can be able to match that rental income. Those are people buying the social houses. And people buying the affordable houses, and now the houses between 3 million to 5 million will be able to enjoy the rates of 6%. This is something that the State Department of Housing has already floated to financial institutions, and the financial institutions are working at how do we fast track this so as many Kenyans can be able to own houses. And these houses are more on the government houses, less the private developers. You find that the affordable housing, we have the private developers as well as government who has gotten in as a developer. And now with the KMRC, we are able to finance houses in between all the way from 6 million to 12 million at a rate of 9.5%. So those are the categories that are there. So we'll be able to take care of even the informal sector. I may say that maybe someone could be earning an income of less than 3,000 or those 5,000. With 3% now we'll be able to accommodate as many people as possible. And you know very well, the reason why we have 30,000 mortgages in the industry is because of the price, the interest rates that are there in the past. So if at all we're able to move from 9.5 to 6%, 3%, we'll be able to see the number of mortgages improving and more people owning houses in different categories. And we can't wait, as for us as HFC, we can't wait for the government now to start availing this money for people to be able to borrow at 3% and 6%. That's our joy, and at HFC we say our purpose is to be able to enrich lives, and how we enrich lives by advancing loans for people to buy their own houses. Because a home is the most expensive investment one will ever make in life.
Okay. Before you take the next question, so you said social housing, prices of 1 to 2 million for people below 50,000 shillings. How about the 3.5 million next percent? What income band is that?
That income should be in between 50 to 149,000.
50 to 149.
50 to 149,000.
Yeah, and for the 6 to 12 million, 9.5%.
That one now is open. There is no income limit.
Okay.
There's no income limit, but there's a limit on the value of the property. The property should not exceed 12 million.
12 million.
Yeah.
So this property, where would it be located, for instance?
I mean, since we have the government properties, but also have the private developers. And we've seen quite a number of people getting into more developers in the affordable housing space. Reason being, there are quite a number of levies, and I know Brenda was able to mention them. There are quite a number of levies that the affordable housing developers are able to access, whereby if a developer, I'm developing more than 100 units, I'm exempted in the corporate tax, as well as there's a levy on the levy line, and you know, Brenda was able to mention that. There's a levy, and there's, I think there's like 3 taxes that are they're exempted. So someone has to be able to apply through the State Department of Housing and then through the KRA. And that now we have seen more developers getting into this space. And the units are maybe mostly it's within the county headquarters, or what you usually call the municipalities. We've seen quite a number of units being developed. And with the devolution, someone doesn't have to say that they're buying the properties within the main cities or the major 6 cities. We also have seen other cities coming up, other counties coming up. And so units are available around the country. And for HFC, as long as the property is within a municipality, we are able to support that customer. It doesn't have to be Nairobi, even in Kakamega, Meru, Embu, we're able to support the customer.
Okay, I was asking that question because the people who are here maybe their lives are centered around Nairobi, but we can talk about that later. This is a question from the audience. Yes.
Hello, my name is Brian. I have a question to Brenda. Yeah, the question is recently we shifted to shift before shifting to HIF, which allowed some relief in the payroll. In shift, we are still in that, not getting whether we can connect from relief. So maybe you're getting there will be okay. Then another thing is talk in the air. We have been hearing what the CS president has been saying, that he's planning to bring in a bill that will enable the citizens of Kenya who are employed that before the deduction, or rather the tax amount is calculated, now we deduct the house levy, SSF, charges. In your view, does that make sense and save the earner, or it's making it even worse? So I think your wisdom there will really be appreciated.
All right, Brenda, go ahead.
So I'll start with the shift. The shift one has been a problem really, I can admit. So initially we had NHIF, and for NHIF we had a relief, the insurance relief for 15%. Now this has affected payrolls for last month because KRA had not come out clear to tell us if there is a relief or not, and other people had gone to ask on Twitter, KRA Care, and KRA Care is confirming there is relief. So some employers went ahead and gave relief, which is wrong. So ideally, before you do anything, you should have a legal provision to support. The insurance relief that is in the Act is only for NHIF. So people have raised it up with KRA, asking them to give a solution because they had not communicated. Others deducted, others did not. So that one still remains a gray area because they came up with the public notice much later. Now, in the finance bill, the controversial finance bill, the government had proposed to have instead of having a relief, you realize that when you talk about a relief, you've already computed your tax, you know what you're going to pay. Then that relief automatically, you know you're going to less that tax by that amount. But now, they want to go to the deduction side. If you look very well, relief is actually better than a deduction because for relief, it's just deducting the tax due. So they had proposed that, which is also still a proposal in there are some amendments, proposed amendments bills that are being reviewed right now. So the government is moving more to deductions than reliefs. So even for shift, they had proposed it to be like a deduction. So like right now, you can't claim a relief and it is not yet clear if it is a deduction yet. So it's still a gray area. But what I can say is we are moving to that direction of deductions from reliefs. So that is what you can expect. It is also a proposal to the bills that are going on. So the benefit, if it is a relief, is better than if it's a deduction, in short. Yeah.
Okay. Another question from, yes.
Before the next question, for those who want to use the washrooms, when you get out, it's on your extreme left, so you'll see them well labeled. And if you're also walking out, there's a QR code at the back of the tables. Please just scan that for feedback. Thank you.
Thank you very much for all the presentations, and this goes to the tax lady. Because of so many deductions, my concern has been, we don't know what the employer does, but my concern, since he said that we can also raise concerns, I've actually been asking, I don't want any raise anymore, because the more I'm raised, the more I dip, it becomes less. So I'm wondering what is the problem?
I do understand where you're coming from. Actually, we have so many deductions right now. We have NSSF, and remember the rates were raised.
Yep.
That is the first one. Now we have SHIF, which is 2.75% of your gross salary. And then we have affordable housing levy, which is 1.5%. Then we also have NITA, which is usually 50 per month. Now, I'm trying to see a way around it, because you know the employer has an obligation. The employer, if the employer does not deduct as provided by the law, they will come for the employer. You realize even for payee, they don't come for you as the person who is earning. If the employer fails to do what they are required to do, they'll go for the employer. So as long as you're employed, and because the employer is following the law, they'll have to do what they need to do, or they'll be fined actually, and the fines are really crazy. So, well, as long as you're a Kenyan resident and you're employed by a Kenyan employer who is following the laws of Kenya, and they have been told to deduct SHIF at 2.75%, they will do that. So the only way, as I had mentioned, you can at least save some ways, the deductions I mentioned, of which like retirement planning, where you save in a retirement pension fund, where now they reduce the amount taxable to tax, and the mortgage, and now the relief. But you realize relief, now we are remaining with personal relief, insurance relief for NHIF, which is now like will be under the deductions. So it's more of a legal thing, because the employer is just like fulfilling the obligations as required by law.
But Brenda, is there an alternative? Because there are also employers here. Is there an alternative if you want to advance a benefit to the employee? Is there a different way of doing it without subjecting them to the next level of taxation?
We have like the tax-free benefits. For example, if an employer is providing a meal to employees per month, you give them, there's a cap of 4,000. So up to 4,000 it's not taxable. So most employers, actually this is like tax planning for employers. If you're giving meals, most of them give up to 4,000 because they know that's a tax-free threshold. If it is per diem, you know per diem, there is a tax-free threshold of 2,000. So you realize if you go to work outside, most employers will give you 2,000, because if they go past 2,000, it will be taxed. There is this non-benefits in kind, like airtime and the likes. There's also a threshold of about 3,000 per month. So most of the employers in their structures go by those tax-free thresholds when they're giving benefits. But in terms of the actual benefits, like a salary that you have received, that one, it is recommended by law for them to tax. Even if the carrier come to audit, they'll just see this is salaries and wages. Did you follow the law? Did you tax like this? So the only benefit they have is the tax-free benefits.
So the meal benefit, do you provide ugali and beef, or it's in cash?
It's mostly any kind, because like for example, if you claim an expensive meal, they go, this happens mostly in audits. They know that how many employees do you have? 30. What is the tax-free? 4K, 4,000. So they do 30 times 4,000. So they expect that what you can allow, what you can use to deduct is that 120,000.
Okay.
So anything above and beyond, they will tax it.
Okay,
Yeah.
all right. Here's another question, and let's circulate it to the other panelists. I know tax is pressing, but please raise your question.
Okay, mine is to find out, does KMRC finance for building?
Say that again?
Does KMRC finance for building? I want to build, so can they finance me so that I build on my own?
Okay.
All right, I can confirm yes. Some of the available products that are available under the KMRC financing is our outright purchase, where I'm buying an already complete house or a house that is off plan, that is available. Also, we also have an option whereby you want to buy land and simultaneously build. That is, we call it at HFC, we call buy and build. We have that option. And if you already have an existing piece of land somewhere, we can be able to support you to construct that house under KMRC financing at a rate of 9.5% for a term of 20 years.
Okay. There's another one? Yes. Sister.
I go?
Yeah.
Thank you. I'm thinking about the alternatives that we can have in terms of tax planning. And I don't know what help the guys in insurance and pension can help us, because apart from the pension that maybe the employer is paying for an employee, I can decide to have a voluntary gratuity that can help me to save on my tax. Because thinking of my employer increasing maybe benefits to an employee to get some rebate on tax, it may not work because the employer is also seeking to save on their expenses. So I don't know what solution or innovation our people in pension and insurance can help us for us to be able to move on that direction, to be able to have some money in our pockets because it's all gone. Thank you.
Okay, all right. How many mics do you have? We have just one. Maybe you can share the other one so that you can take some more questions.
Thank you. My question goes to the retirement planning. Most people who work for the government, we know that our money goes to, I don't know, is it NSSF for retirement? But we don't know how much is taken there. Upon retirement, that's when you're told this is the money that you're going to get. So most people don't even know how much is deducted by the employer. And so we cannot even tell them if we have any relief or something. Is it possible to know how much the employer takes to NSSF? And if so, if somebody can get a relief? Thank you.
Okay, we can take another question. Is there a hand for a question? Yeah, moderator.
Thank you so much, our presenters, for the very enlightening session. Mine is a clarification on tax planning. And I'm an accountant. And some of the tax planning I used to see was through staff training. That is, if I want to do an MBA, if the company pays me for that course, it used to be a tax deductible expense. But if they pay me and I finance the MBA myself, then I still suffer tax. But if the company pays it used to be a tax deductible expense. So I just wanted a clarification. Is that still the position? Can staff training be a way of tax planning? Thank you.
Okay. Do you have another hand? Because you're almost clocking an hour. Patricia?
Good afternoon, everybody. My name is Patricia Gaduri, ex-banker, so really interested. I'd like to ask the panelists, I know two of them, we used to work with them, I'd like them to confirm and to clarify to the members on this, on KMRC, because it's not coming out clearly that KMRC was established by a Companies Act in 2015 and is regulated by Central Bank of Kenya, and it has a number of participating banks. So people do not actually go to the Kenya Mortgage refinancing company, you go through the banks. So when there's a question on whether the banks, KMRC lends for mortgages, it can be either existing houses or construction loans. But please explain to them, I know what it is, the methodology and how KMRC works through the commercial banks that are participating banks. I just wanted to make that as a point of clarification. Thank you.
Okay. Do you have another pressing hand? Because this is the last question that I want to offer an opportunity for. We don't have. So let's take the responses and then I'll ask you to close.
So I will tackle the two questions about retirement. And I think, Sister, you had asked the first one about like alternative maybe to pension, maybe that you can do yourself. So firstly, you can get that outside what maybe employer is giving you, okay? But then it depends on your level of patience. But the advantage that you can get, let me give you a case scenario. I can choose to decide to save for my next 10 years. Because you see, what most people I've noticed are doing, if I'm changing employer to somewhere else, I want to access my pension, right? That's what most people are doing, and that's the reality. But you see, the maximum you can get is 50% of total contributions. Ideally, that money is supposed to cater for your later years when you're retired. But try and remove that money before maybe 65. The challenge is hefty tax, okay? So for you to, like what was mentioned, for you to have maybe tax-free, enjoy your money as it is plus interest, is to access it after 65. Now most of us, if I do your age plus 10, you won't even have gotten to that 65 years. So we have alternatives, like maybe I can choose to save for my next 10 years, for my next 15 years, from as low as even 20 years old, okay? What's the advantage of that? Let me say even to as high as 55 years, tax-free. So the money that you get is tax-free. You don't have to wait to be 50, 65 and get my money tax-free, because I usually feel that's your hard-earned money, and why should I be penalized, okay, for doing a task I've obligated myself? So the advantage is, number one, you get a better return. Then maybe someone had mentioned that it's difficult to follow up. Always will give you a better return because of the places we invest your money, okay? So number two would be, fine, 10 years seems far, especially I can see the young guys here, but I still want to cultivate that discipline of savings. So still, again, the benefit you get, the returns are tax-free, and the 15% tax relief. Let me explain what that tax relief means. It means maybe a Martha, right now, I'm starting out in life, 20 years, right? Maybe I'm in my first job, 22 years, and I want to start that journey of saving for my retirement. What I can afford in reality, maybe it's 2,000 shillings. What's my benefit there? One, the returns come tax-free. So that's a good thing for me. I'm saving there. Number two, I get a tax relief, which means it's 15 over 100 times the 2,000. So most people used to use this as a way of evading tax. So the maximum that you can get relief is 5,000. So from your 2,000 shillings every month, there's about 300 shillings that you're saving, which is an indirect savings for you. Because some companies, if you're employed, like she mentioned, you get that relief done for you. So it's like you're actually paying 1,700 for that investment for yourself. If maybe you're not employed, like for the people in business, when you're filing your annual returns, there's a saving for you, because after some time, KRA will do that refund for you, okay? It might not be every year, but after some time, you get that refund. Then, other than that, it comes with a free life cover. So maybe I'm starting out, I have my family, God forbid I am not there to give them their best life, there's money payable to them. So even in terms of like, maybe you are saying alternative to government pensions, because reality is, their job is not to look for the best places to invest your money, okay? Then they'll just take your money and tell you, this is what your money is, and you notice the return is not so much, and it's difficult to follow up. But if you do this investment from my colleagues or whichever institution, you're able to monitor in terms of, this is what I've been contributing, this is how my money is growing, this is where it's being invested. So you don't have to wait for an employer to give you pension. Some employers are not giving pension, but you can actually start these investments on your own.
Okay.
Yeah.
All right, let's give the responses short. We're running out of time.
I have three responses. There was a question on how the employer can go about it, and she has prompted me on the tax consulting, the consulting services. You know, consulting, you just pay withholding of 5%. Now that will be a tricky part for the employers, because right now, if you're an employer, there is a distinction between an employer and a consultant. So if an audit is done and it is identified that you are actually an employee and not an employer, the employer suffers because they'll tax him at 30%, not even the graduated scale. So if you're an employer and you're trying to find how you can fix your employees, don't go for the consulting issue unless those are actual consultants and you can actually support that they are consultants. If not, you are the one who will be liable to pay all that tax. So that one is out of question. The second question was on NSSF. How do you know your employer is doing what is supposed to be done? There are options. There is a WhatsApp code that you can use to contact NSSF. and then they give you the statement. Alternatively, you can go to their offices, share with them the details to know how, if your employer has been remitting the NSSF deducted. So those are the options available at the moment. And also, when you're given your P9 to file your returns at the end of the year, the employer shares with you how they have been calculating. So you'll see there, they have deducted NSSF. So in terms of remission, you can visit their offices or use their WhatsApp code to request for your statement. They normally share. So it's important to check actually if your employer remits, because if they don't remit and you go to NSSF, they tell you they don't have funds, there's nothing they can do actually. So you pick it up with your employer. Okay. The other question was on the MBA payments for education. So what happens is when your employer pays for you, that is more of a benefit. So that benefit is either taxed on the employer or either taxed on you. So if it is taxed on the employer, I want to explain this very simply. You remember we talked about deductions. So if we deduct an expense, it means it has not been taxed. So in such a scenario, if it is the fees that has been paid for you, the employer will not deduct that. If they don't deduct, it means it has been taxed on them. But if they deduct it, you will have to pay the tax. I don't know if I'm clear. Yeah, so it's a two-way thing. If the employer claims that expense, it means it has not been taxed. So you, as the person benefiting, will be taxed. But if that employer does not claim that, it means it has been taxed on the employer. So that is how it works.
Okay.
I think I've responded to all.
All right.
All right. I'll mention how KMRC was born. And I think I'd mentioned earlier when the previous government came in 2017, they launched affordable housing. And one of the challenges that they're trying to address is whereby Kenyans are able to own decent housing. And so the affordable housing agenda was born, and from that was there to address the challenge of financing Kenyans at affordable rates. So Kenya Mortgage Finance Company was born at that time, and how it was born is that quite a number of financial institutions, including HFC, were able to put in capital, and they became shareholders, of where also government, through the National Treasury, they are also shareholders in Kenya Mortgage Finance Company. So now what Kenya Mortgage Finance Company, or what is commonly known in the market as KMRC, what they do is that they access money from DFIs or some other financial institutions like World Bank and IFC and even African Development Bank. So they access loans from those financial institutions, World Bank and IFC, and then now once they access money at affordable interest rate or concessional or discounted interest rates, now they're able to lend to the financial institutions. KMRC, they call these financial institutions primary mortgage lenders, and mostly they are banks as well as SACCOs. Currently, there are 6 banks or 8 banks and 8 SACCOs, and all these now they access money from Kenya Mortgage Finance Company at concessional rate, or maybe at a concessional rate, and now we are able to lend to people, to you and I, so that you can be able to buy that house that you want to be able to buy at an affordable housing. So like HFC, they're able to access money from Kenya Mortgage Finance Company at a very discounted rate, and then for us now we're able to lend at 9.5%, so as you can be able to buy that home that you've been thinking about.
Okay, I want us to close as we come this direction, starting with you, Peter, if there are any concerns that you don't respond to.
Since there was no question, either people understood it or they didn't. But allow me, it's very interesting, diversity of thoughts, but it's narrowing down, believe you me, some to grow in your wealth. When you look at my colleague here dealing with insurance, it's about protecting the wealth. When you look at my other colleague here about mortgage, it's about building the wealth. And even the colleagues here, tax matters, tax efficiency, it's working towards increasing your income. And once you reduce the tax, or you work your way out to ensure that you minimize the tax, you are increasing your income, and that gives you the trajectory towards building your wealth. In a nutshell, let's just be practical. We are all here to make money, to build wealth. All the other diamonds you have will narrow down to one thing. After you have had it all, what is left is what counts. Because money as we saw, it is transient in nature. You will have much of it, but what you leave as a legacy is your wealth. So what is wealth? Wealth is basically your network. You remove you take all what you have as assets, remove all the liabilities, and what you are left with, that's your wealth. So in a nutshell, to grow your wealth, we have mixed various strategies. First of all, you have to have a budget. And of course, you have to stick to it. And when you're having a budget, you are chasing what are the sources of income streams.
Yeah.
And where is money going? So where the money is going is your expenditure. So if you are around and have that formula,
yes,
then you have it right. Then the next one, you have to have an emergency fund. If your situation is not precarious, it's not that stable, at least build a buffer of around 6 months of your emergency that can meet your living expenses. If in such a stable situation, maybe 3 months is okay.
Okay.
Again,
Peter, we're out of time.
Yes, the last one. Then the financial discipline is key. And without much ado, I would say, if you are growing your wealth, start where you are. If you can afford to start with a high amount, that's okay. If you are allowed a little amount, you still have vehicles that will allow you to participate in creating wealth.
Okay.
And as we said, in started investment,
thank you, Peter.
That will make your wealth grow at a rate of 70% rate of profits.
Thank you, Peter. Now, Winnie, please, 45 seconds. Nothing beyond.
I would like to tackle the question of our sister there, as about the pension, how you can reduce taxes. Remember, there was 2019 Taxation Act, which were up to the maximum of 30%. For somebody who is a the pension is 600, low taxation, another 200, 10%, another 250, to the maximum of 30%. Basically, when you're getting your pension, those who are employed, you'll be taxed up to the maximum of 30%, depending on the value of your pension. What I can advise, you can have a discipline savings whereby it has 15% tax relief to the maximum of 5,000. That will reduce the tax for you. And it's a discipline plan also to make sure that at the maturity you don't be taxed, and then the pension that you are having when you are employed. Thank you so much.
Well done. Gilbert, 45 seconds.
5 seconds going now. I would like to say, Miriam has just put it very well. A fuel tanker needs fuel. Don't think that just because you're here where you are right now, that you cannot get more information. Talk to these guys, talk to the Britannians, the youngsters. Let them help you secure your future and aspirations. Let them help you look at your future with confidence. Alright? Wealth is created slowly by slowly, but you need a financial plan, you need a financial advisor to help you, whether you're an accountant or you're a businessman. Listen to these people. Thank you very much.
All right. Thank you, Gilbert. Linda?
As first, let me say, we've talked a lot about paying taxes to the government, but there's an option where you can actually invest and not pay taxes. So you can invest in what is called the infrastructure bonds, and when you invest in that, it is actually tax-free. So there's a way you can make money from the government and not pay taxes. So it's just good for all of us to do that. And then I'd also like to raise an issue she has spoken about, which for me is very, very personal. Last week we had, in the business daily, they reported 75 billion sitting in unclaimed financial assets. 75 billion. And the reason for this is because we are not talking about our finances. We are not talking about the investments we are making with our families. So you're making investments, your wife doesn't know, your children don't know what you're doing. So for me, it's just to encourage us, let's start having these open, honest discussions about our finances. We all have families, we share our expertise with our family members. So please, that 75 billion could be doing a lot, and it belongs to us and our families.
Okay.
So please, that is, I think, very, very important. Open, honest discussions about families, about your finances. Come together, plan for your finances together as a family.
All right. Thank you so much, Linda. The tax laws amendment bill 2024 is proposing to start taxing.
Yes, they wanted to start taxing 5% on the infrastructure funds.
Yeah.
Please, and I think that's why maybe they've not floated one as yet, but if they do float one, please buy, because they will not tax the previous infrastructure funds going forward.
Okay. All right. Thank you so much. Let's give a clap to. Thank you so much, Linda, Gilbert, Winnie, Peter, Stella, Brenda, and Nzomo for making time for us to have this conversation. We'll continue to have it. Just this week, someone told me that a lot of us are buying land and a lot of billions are held in land. What if those billions were invested in a productive sector to create manufacturing, to create jobs? We need to think about that. Asanteni sana. See you some other time.
Thank you so much, Sam and the panelists. I think that was quite insightful. Don't we think that? Yeah, so another round of applause, please. So we'll now take a health break. There's some tea that is being served downstairs. There's a room that has been set aside. Please have some tea. We'll start the next session at 1:15. But as you leave, please scan the code at the back. We have a very engaging panel in the afternoon, and you don't want to miss this, especially if you're in business, and I think that's where most of us are going. We'll have a couple of banks here just talking about business finance and anything around supporting businesses, and of course, tax will still be discussed, KMRC will still be mentioned. I've had a lot of questions about tax, and I think we'll still have more. Key takeaways: start small, grow steady. Budgeting and protection is key, especially when it comes to insurance, and plan for the future. Maximize your benefits. I think all of us have learned something today. So let's take a break. Let's be back here at 1:15. Thank you so much.
you.